With the pandemic going on, the markets have been a little bit jumpy, to say the least. How is that reflected in the activity that you see across your exchanges?
If you think about what's the biggest driver of volume in the markets, and it's volatility. So when we look at the volatility index, and it really spiked up in the very end of February and through most of March, our peak days, we were processing 62 billion messages in the day.
Wow.
And that, if we looked at kind of what that equates to in terms of messages per second, in our equities markets, we were managing about a little over a million messages a second on average. So that means that the peaks were higher. And in our derivatives business, which is largely the U.S. options markets, we were peaking at around 3.5 million messages a second. Our median latency across our markets was about 30 microseconds in both of those markets.
And in this context, what do you mean by latency?
So how long does it take for an order to come in, convert to a trade, and then be sent out? So that it is, and so that we create as seamless an environment as possible to managing the inbound orders, giving a confirm on the order, and then managing the trades and giving a confirm on the trade out to the clients so that they know with absolute certainty that the order was received and that the trade was executed.
Just to give people a flavor for the speed that we're talking about, you are in 30 microseconds taking a message, actually doing something with it, and then sending out a kind of confirmatory message, all in 30 microseconds. It's a mind-bogglingly short amount of time. You and I talking and sending a signal over the internet from the UK where I am to the US where you are, essentially at the speed of light with a bit of electronics in between, has a 500 millisecond delay. So it's thousands of times slower. So how on earth do you manage with all of these different market participants, this incredible volume, 3 million messages a second, to do this in 30 microseconds?
I mentioned before that the CIO is the person who really drove our digitization efforts in NASDAQ. But obviously, as a technology business, our CIO is the most strategic role that we have in many respects, because all of that work needs to be done and fine-tuned in a matter of really focusing on speed, resiliency, and throughput. People expect the markets to operate flawlessly all the time. So we can basically fall over to backup data centers very, very seamlessly. But in our data center, we also have our clients, and we call that co-location. So our clients have essentially established servers in the data center. We give them each an equal length cord, literally a physical cord that is an equal length between their server and our servers, so that no one can gain an advantage inside the data center. But even the retail brokers, as well as the most sophisticated traders, they obviously then build high-speed cables between themselves and their own servers. So it's a very sophisticated infrastructure that supports the inner workings of the market, but recognize that everyone has access. We're highly regulated, so all of our fees are equivalent. That cable is a good example of trying to make sure we have equivalence in the data center.
I hadn't heard about the cables being the same length, because many years ago, I worked at Reuters, which is a financial services information business, and I helped launch a product that enabled algorithmic trading of stocks. And at the time, proprietary trading desks and hedge funds were trying to position themselves physically closer to where the exchanges were in order to get that millisecond difference, because the signal has to travel less far, that might provide a trading advantage. And that was, 15, 20 years ago, I guess. And the way that you tackle it nowadays, in partnership with the regulator, is everyone gets the same 25 yards of cable or 200 yards of cable or whatever it is. So you're all equally advantaged or disadvantaged.
Yeah, and I think that there has been, there's been a lot of discussion around this concept and construct of co-location. But I do think that if we weren't regulated, and if we didn't do it in a regulated way, what ends up happening, because in other markets it's less regulated than it is here, is that people build buildings all around the exchange's data centers. And so that's a much bigger capital outlay to have to build an entire building and then have their cable running through. So it actually is, in my opinion, a better way to do it where it's highly regulated.
Of course, the history of stock exchanges is intimately connected with the history of communication technology. And the telegraph was one of the first things that broke sort of existing stock exchange rules 100 years ago. I'm fascinated by how you were able to ride this growing volatility. We've seen that as volatility and uncertainty hits other parts of the global market, for example, supply chains, these things fall over and break. So, what do you think it is about your particular industry that has meant that there is this resilience and spare capacity engineered into it? Is there something to do with the participants? Is it to do with the regulator?
Well, I think there are a few things. One is that we have managed through a few crises in the past. So, particularly for the U.S. exchanges, 9/11 was a seminal event where to have to close the markets like we did for 4 days was unprecedented. In fact, I don't know if you know this, but we aren't allowed to stay closed for more than 3 days at a time. And we actually have to get special permission if we have to close for a fourth day. And that, by the way, includes weekends.
Right.
And after 9/11, our clients were completely incapable of connecting because all of their infrastructure was sitting in New York City. So the first thing was that post-crisis moment meant that people created much more distributed infrastructures, and the regulators were very focused on that. Then we had Superstorm Sandy, and it really impacted the infrastructure again. And that's when I think a lot of the financial services clients really started to distribute out their infrastructure in a much more sophisticated way and creating more work from home capabilities. And so those two things were important. But the third thing is that our entire industry is really driven by technology and data. And there is obviously an enormous amount of money that flows through our systems and is dependent upon the system being fully operational in a lot of different environments.